Tariffs creep into consumer prices. What does this mean for the Fed? Joining us today is Eric Diton of the Wealth Alliance. All right, Eric, we saw that prices ticked up a bit in June with today's CPI report. Where specifically are we seeing those potential tariff pressures?
Well, first off, in the words of Karen Carpenter, we've only just begun. And we have. The tariffs are just starting to get in there, but definitely we're seeing it in housing. Think about it: aluminum, steel, the basic inputs of housing, food and energy. And if you want to get specific, you're seeing it really in apparel, toys, furniture, electronics. Those are areas where we're seeing it. And look, the CPI number looked pretty benign. Came in at 2.7. Expectation was 2.7. Well, let's not forget it was 2.4 last month, and core is 2.9. So it's just under 3%. It's pretty far from the Fed 2% target, and we're just starting. So we got to be a little wary here. And if I'm Jay Powell, I'm not in a rush to cut rates. As he said, he wants to see how this plays out.
Well, President Trump, as we know, wants Jay Powell to cut rates now. So when is the soonest this happens? I guess there's no scenario under which they cut rates in July. What do you think?
I don't want to say it's a 0%. No one really talks about this, Lisa, but the bottom line is that since World War II, the spread between the Fed funds and the 10-year is generally 1 to 2%. So if the 10-year is at 4.5, really the Fed funds in a normal world should be between 2.5 and 3.5. Right now we're 4.25, 4.5. So it is too high. So they do have leeway, but I hate to use the word uncertainty. It's just been massacred. But look at what is going on right now with the tariffs. I mean, it's changing by the day, it's changing by the week. Canada, the EU, Mexico, copper just had its biggest spike since the 1960s, biggest one-day spike with the tariff on copper. So there is just so much that we don't know. And the economy is doing well. We're at 4.1% unemployment. What's the rush? That's what Jay Powell is saying. What's the rush? Economy's chugging along with rates where they are. Why do I have to cut rates so fast? Let's see how these tariffs play out. It's hard to disagree with that. Makes sense.
So when Trump pushes for a 1% Fed funds rate, is that a New York real estate developer talking?
For sure, we're going to see interest on the federal debt top $1 trillion. That's a scary number. And if I'm Trump, I want to see interest rates come down as soon as possible. Don't forget what happened the last time the Fed cut rates. A few times they cut it 1%. What happened? Long rates went up 1%. Didn't work. The market got scared. And Trump's got to be careful, because if he leans too hard on Jay Powell or replaces him and brings in someone who is a Trump yes man, we are endangering the dollar as the international reserve currency. The world has faith in the dollar for a variety of reasons, but one of them is the independence of the Fed. So I wouldn't really mess with that, even though, let's be real, Truman did it, Lyndon Johnson did it, Nixon did it. Trump's not the first president to try to bully the Fed, but we're at a very precarious situation here with the debt sitting somewhere around 36, 37 trillion. It's not the time to play games, in my view.
So what else concerns you about the broader economy and the stock market? Because I know that you've been very bullish on stocks.
I really was very bullish on stocks the last time we met, because the negativity was so extreme. We saw really extreme numbers. And so we're talking today, it's a very good time to have this revisit, because the sentiment numbers have absolutely spiked the other way. There's a Barclays Euphoria Index. I look at all these things. And meme stocks are rocking again. SPACs, which were dead, are rocking. Bitcoin just made a new high. You are seeing all those signs again of rampant excess speculation. The Kathy Wood, the ARK fund, just had one of its biggest moves in years. So that, just like I was bullish when everyone was negative, this makes me tuck my horns in. I am cautious here, not in a rush to get really huge money to work. Although I told you, as you know, I still like international. It's been beaten up for so long. It's cheap, and there are multiple reasons to be in international as well as emerging markets, and both of those areas handily outperforming the S&P year to date. My biggest worry, Lisa, is the debt. It is the debt, because the big beautiful bill confirmed our worst fears, even though there are some things in there I'm sure a lot of people like, but it confirmed our worst fears that there is no policy in place to address this spiraling debt. It's going to increase. Deficits are going to be there. We don't see a near-term solution. When does the market say enough is enough and the bond market demands sharply higher rates? I don't know when it is, but when it happens, it's bad for bonds and it's bad for stocks.